This is Brian Carlton for ABN Newswire. I'm back at Sydney's Bowlers Club for another Symposium Resources Roadshow, showcasing some of the performing and more than promising companies in Australia's still booming resources sector. The keynote speaker at this March 18, 2010 roadshow is Stephen Bartrop, Managing Director of LimeStreet Capital, a new fund manager specialising in the Australian resources sector. Stephen's got 20 years involvement in analysing resources companies from both the technical and the financial perspectives, with major global players including Macquarie, JP Morgan, Bankers Trust. Prior to that, he was a geologist for a decade with companies since acquired by the likes of Rio Tinto and Xstrata. Hi Stephen, welcome to ABN Newswire.
Thank you, Brian.
LimeStreet Capital had a very impressive 09 given the turmoil, 12-month returns of nearly, 108%, almost 20 points better than the benchmark resources index. To what do you attribute that success?
Look, I think it's all about stock selection. So at the end of the day, we certainly had the global financial crisis, end of 08 going into 09. And basically, I guess we had a collapsing of the share prices and then a great recovery coming through. But therefore, at that time, it was very much a positioning of the stock selection to capitalise on those early movers in terms of commodity prices.
You tipped that was going to happen though, didn't you? That's the key there. You realised that was the trend.
Look, I think, you didn't have to be Einstein, I guess, to basically look back and look at, certainly from the commodity prices and resource shares, they bottomed in November 2008, and the rest of the market really bottomed around March 2009. So there was certainly upside there. China was still bubbling along, albeit had corrected to some degree, and our expectations were that there would be a strong recovery, and indeed that's what we've experienced.
There's still some doom and gloom, double dip predictions around. They're in the minority now. Any chance?
Look, I think particularly with the US, and there's a lot of talk about double dip recession there, I think if you look at the Premier of China, his comments over the weekend, he's quite cautious. So that's actually quite comforting, because one of the real risks, of course, is not so much the double dip, it's more the capacity of China pulling back growth and basically stemming the commodity demand, which clearly would have impact on Australian resource companies. The double dip side, from the US perspective, I think we're coming through. There's more confidence that that's not going to occur. Perhaps unemployment has peaked, and we're starting to get some recovery in the housing and certainly retail.
There is some analysis at the moment suggesting that China might overcook. It might the growth might be too high, you'll end up with domestic inflation, the government will then have to start putting the brakes on. Is that what you're talking about? That's
right. Look, and again, it's interesting. I guess the Premier highlighted that they weren't that concerned about the inflationary aspects. Certainly growth is bubbling along in China, and their target, the target of 8%, is certainly going to be exceeded. But I guess if you look at the World Bank forecast that came out, just yesterday, the World Bank's targeting growth in China at 9.5%, but also commented that it doesn't believe that inflation is going to be a problem. So, and similarly, exports are going to pick up. So, its view of the Chinese government's ability to manage that economy is quite comforting. And I guess combined with the fact that the Premier is pushing the fact that they're not going to aggressively tighten or shutter the economy, actually bodes quite well for commodity prices in Australian resource companies.
Which leads me to my next question. I'm reading some very bullish analysis of how well the Australian resources sector is likely to perform moving forward. A bigger boom than we've ever seen is what I'm hearing.
Look, certainly the Reserve Bank of Australia has got very excited in terms of the prospects going forward. I think, as economic data arrives, and particularly some of the data like the World Bank forecast and so forth, there's no doubt, commentary like 300 million Chinese going to build 300 million houses rather, over the next number of years. That is a huge demand in terms of commodities and resources, and as Australia, we're certainly in a prime position to supply those commodities.
Is it sustainable? And for how long?
Good question. Look, it's a long time to build those houses, and the construction's going to continue. So, look, I think we've certainly got decades there. Overall, I think that the turning factor is more likely going to be a reflection of what the Chinese exchange rate, or whether the Chinese government free up the exchange rate and so forth. So then you have a situation where you start having exports perhaps being less competitive, and then of course what China's going to do is start exporting capital, perhaps as we saw Japan did, as the yen rose back in the early 90s.
Now, back to Australia, what specific resources do you see leading the charge here? Is it the usual suspects, coal, iron ore? What else is coming through?
Look, the bulk commodities are always a favourite, and clearly they're focused or their target market is very much the industrialisation and production, and the development of China and urbanisation and so forth. But look, base metals are very attractive, and copper is certainly the bellwether of the base metals and in fact a lot of the commodity prices. So what we've found is we've actually gone through, at the moment we've got bulk commodity price negotiations that look very encouraging. As we go forward, in fact from a portfolio perspective, we're actually moving more towards, after, over the next couple of months, we'll move more towards base metals. And I think our expectations in the latter part of 2010 are very much that the base metals, and particularly copper, will start to pick up in price.
Let me talk about some of the coal variants. Coal seam gas, underground coal gasification. There's some very exciting noises around these technologies and these processes at the moment. Are you a fan?
Coal seam gas, you extract about 5% of the energy out of the coal seam. You have to dewater it. With UCG, where you actually physically burn the coal underneath and extract a gas called syngas, which is largely carbon monoxide and hydrogen, that actually extracts 95% of the energy of that coal seam. So there's a huge energy uplift if you move from just extracting the coal seam gas to UCG. The complicating factor, of course, is the fact that coal seam gas tenements are different to tenements that you can use ECG with. So, of course, you've got the Santos and the companies I've just mentioned. Yep. The major players all have coal seam gas. They don't necessarily have the rights to the UCG production of their coal fields that underlie their tenements.
So there's multiple uses for it too, obviously. You can put it straight into a gas turbine to generate electricity, or you do a gas to liquid conversion. It goes to a very pure, clean burning diesel fuel that you can put in your Volkswagen, essentially. Is that going to be a major part of the use of that new technology? Will they be some of the final products we're looking at?
Look, I think they will be, and the leaders in the Australian market, I guess, are obviously Link and Cougar and Carbon Energy, and they're looking at various forms, but it's driven very much by the price of oil. So as the price of oil starts to exceed the $80, the magical $80 US a barrel, which it has and it is, as it starts to move up, these competing technologies become quite economic, and certainly taking that syngas production or product and turning it into the gas to liquids that, as Link Energy are proposing.
What's ahead for LimeStreet Capital?
Look, we're quite encouraged. We see strong growth going forward. We're in the right sector, and essentially being an ex-BHP Rio fund, if you look at the whole resources sector in Australia, 32% are resources out of the ASX 200 or 300. Half of that's BHP and Rio. So many of the funds out there, the classic general resource funds, are all about, is BHP going to outperform Rio or vice versa? We take those out of the equation.
Why are you not exposed to those?
Well, exactly that, because the fact is that we see that our skill base is about picking good projects or good companies with good projects that can deliver long mine life projects, that can attain financing, particularly from China and India and so forth, that are quite keen on securing supply. And it's the value uplift, so on one side you get the commodity leverage from the pricing, which obviously the whole sector gets, but it's very much the capacity to bring, a small company brings a large project into development, and the value uplift that you see through that share price.
Some general advice for those investors, there's many of them not too far from where we are now, looking at getting into the Australian resources sector if they're not already. One piece of advice for them, what would you say?
Look, it's a great sector, and you certainly should be there, and Australians generally are underexposed to it. Look for quality management, because you know that quality management with a track record will always be able to reinvent companies or redo things and will deliver the value. So that's probably the key, I would say.
Stephen Bartrop, Managing Director of LimeStreet Capital, keynote speaker at the Sydney Symposium Resources Roadshow. Thanks so much for joining me.
Thanks, Brian.
This is Brian Carlton for ABN Newswire.